This week, we're going to begin discussing budgets, and we're going to spend this week on budgets, and then one of our chapters next week will also deal with budgeting. You may remember from early on in the quad, the readings, where we talked about some of what management's responsibilities include are planning and control. And budgets are an approach to actually both of these. We think about budgets as being more the planning stage because we're planning or budgeting what we're going to be doing or how we're going to be achieving our goals in the next year or 3 years or 5 years. But truth be told, budgets are also a way to control, because through the process of planning, we actually have something to hold ourselves accountable. And since we have this budget or this plan that we want to achieve, we have something to control. And so I will often say in a discussion on budgeting that budgeting is not even meaningful if at some point you don't compare your actual results to the budget so that you can make adaptations as needed. That's the control piece. And those adaptations may be needing to increase sales, needing to reduce costs, or they may actually include fine-tuning the assumptions that we're using to build the budget. If we incorporate into our budget assumptions that aren't valid, then we are trying to achieve something that isn't feasible. And understanding that is as critical as understanding that we're overspending something. So with that as background, what I want to do in this worksheet and in this video is walk us through what is called a master budget. Now, my guess is all of us at some level have been involved in a budgeting process, even if it's just budgeting our own personal finances. And we know that the critical piece for the budget is laying the groundwork, identifying what assumptions we want to incorporate. And so the first thing I want to do is walk through the assumptions, and then I'll walk us through the spreadsheets that effectively build that master budget. A master budget is going to incorporate several things. It will certainly incorporate the assumptions. You can't review, you can't implement, or even assess your budget unless you know what assumptions went into it. Then we're going to have some supporting schedules that feed into our end product, if you will, and that end product consists of 3 documents. A cash budget, which will outline for us what our cash flow is, in this case on a monthly basis, because we need to understand our cash flow on a monthly basis so that if we are short or if we have excess, we can plan accordingly in terms of how we're going to address that. Then we want to produce a budgeted income statement. Based on this master budget, what is the profitability that we are suggesting we will achieve? And then finally, a balance sheet. If we achieve this plan, this budget, what will our statement of position look like when all is said and done? So let's walk through our assumptions for this particular example. What you see first is a balance sheet at March 31. So what we're going to be doing is we're going to budget the next quarter for this company. So April, May, June, second quarter. And our starting point is going to be, of course, where we think we will be at the beginning. So this is just a very highly summarized balance sheet that we anticipate starting the second quarter with. Then, and we're going to assume that we sell our product at a gross profit of 40%, which means that cost of goods sold will be 60% of our sales price. Now, just a comment, you'll notice that some of these cells I've highlighted in yellow and some of them I haven't. The ones that are highlighted in yellow are changeable. They're input values, which basically means if you want to change your assumptions, you can change them. So, for example, we may go through this entire budget example and determine that we don't get the results that we're hoping for. So we may go in and say, what assumptions can we change? Some assumptions we may not want to change, but maybe 40% is too high a gross profit. Maybe that's not achievable. How would our results change, say, if we used a gross profit of 30%? So this data that's in the yellow highlighted cells is data that can be adjusted. So continuing with our assumptions. In item number 3, I have outlined our sales data. Notice that when you are doing a master budget, the budget for sales has to be first. Now, I can't budget my cost of goods sold if I don't know how much I intend to sell. So your starting point for any budget, master budget, is going to be sales. So my sales data, I've got what my March actual sales were, and then I've gone out actually into the month of July, and there's a reason for that, and budgeted my sales for each month. Then we have to think about, when am I actually going to collect those sales? Because I may make sales in April, but if I give credit, my customer may not pay until May. And if my cash budget is going to be valid, I need to know what those assumptions are. So for now, we're going to assume that 20% of our sales each month are cash sales, so they'll be collected right then. 80% of our sales are credit sales, and notice my comment box, we're going to assume that all credit sales are collected in the following month. So for example, any credit sales in April, we will collect in May. Now, notice if we were face-to-face and having an exchange here, I would ask you, what am I ignoring in my oversimplistic approach? Think about it for a second. What am I ignoring? I'm assuming 20% of our sales will be collected in the month of sale, 80% in the following month. If you said, I am ignoring the chance that some of these will be bad debt, you're correct. So in my oversimplification here, just to illustrate how the budget is put together, I'm assuming everything's going to be collected. That's probably an overly aggressive assumption. If I were being more realistic, I might say 20% of cash sales will be collected in the month of sale, 70% the next month, and then maybe 10% bad debt. So just keep that in mind. Now, we're going to assume this is a company that is a merchandising company. They sell their product, but they do not manufacture it. So we need to have some inventory assumptions. The first inventory assumption we need to have is, what do we want to have on hand in our warehouse at the end of the month? Because if I want to do a realistic budget, I want to make sure, A, that I have adequate inventory to meet early month sales for the next month, but not so much inventory that I have a whole lot of cash tied up in inventory that I won't recoup until I sell the product. So I am assuming that 30% of the following month's sales I will have in inventory at the end of the previous month. So at the end of April, I'm going to assume that I will have inventory in my warehouse equivalent to 30% of what I plan to sell the next month. And then similarly to collection of sales, when am I going to pay for the inventory? And I'm going to keep it simple. I'm going to assume 50% I pay for in the month of purchase, 50% I pay for the following month. Now, item 6, I need to make some assumptions for operating expenses. I'm going to assume salaries and wages are $7,500 per month of fixed expense. I'm going to assume that shipping is 6% of sales per month. Advertising is a fixed expense, $6,000 per month. Other expenses, I'm going to assume are variable at 4% of sales. And then depreciation, I'm going to estimate at $6,000 per quarter. So I'm looking at depreciation only on a quarterly basis. Okay. Moving on, item 7. This is an operating budget, but we are going to, not a capital budget. A capital budget we'll deal with later in the quad, but a capital budget looks at any sort of capital expenditures, large property, plant, and equipment, perhaps, expenditures that we're going to make, and how do we finance them. Now, what I'm assuming here is that we have some small capital expenditures, some small equipment purchases that we're going to need, and we are going to purchase them out of the operating budget. So they're not so large that we need to create a separate capital budget for them. And so we're going to assume equipment purchased in April of $11,500, equipment purchased in May of $3,000, and then June, nothing. And then the last assumption is financing assumptions. One of the reasons we do a cash budget is to make sure that we don't run into any surprises of cash flow problems. But oftentimes what companies will do is they'll have a policy in place where they don't want their cash to fall below a certain dollar amount. And this is primarily a risk mitigation issue, because if something happens that they don't anticipate, and then all of a sudden they're in a cash flow problem. So in our example, we're going to assume that we maintain a minimum cash balance of $8,000. We also have a line of credit that allows us to borrow on an as-needed basis. However, when we borrow, it must be in increments of $1,000. So for instance, if I'm $1,200 short, I can't go out and borrow $1,200. I've got to borrow $2,000, if you will. And then repayments in the same way, repay in increments of $1,000. And then lastly, the interest on that line of credit is 8%, and we repay it only when we repay the loan. A lot of these assumptions I'm making in somewhat of an oversimplification approach, just because for illustration purposes, it's easier. So those are all our assumptions. Here's what I'm going to do. I'm going to stop this video at this point and start another video walking us through the example, primarily because I know it gets old after a few minutes listening to the video. So here are the assumptions. Keep this in mind, and then go on when you're ready to the next video, and I'll walk us through the master budget.